If you're building a financial portfolio that's designed to pay you whether you're working or sleeping or simply living your life, then you are exactly where you need to be. In this series, we're keeping things super simple. You and I are going to take a clear, honest look under the hood of one dividend stock at a time, with no hype, no noise, just what actually matters. Is the dividend solid? Is it growing? And what is the chart really telling us right now? This is not financial advice. I am not making buy or sell predictions, but what I am doing is helping you understand the market, understand dividend stocks, and understand trends in a way that's clear, grounded, and practical, so that you can make confident, informed decisions at a time that's right for you. Now, we're all working towards that goal of having our investment return be enough to cover our lifestyle. Like having a $1 million portfolio give you 10% return each year and being able to live comfortably for under $100,000 a year. Or having a $600,000 portfolio giving you a 15% return each year and being able to live comfortably for around under $90,000 per year. But let me ask you something. What if the goal wasn't just to chase the highest yield, the highest return, or the highest dividend, but to build income that quietly grows in the background year after year? Because that's a very different game. Now, each week we will be looking at a different dividend-paying stock. And today we're looking at a company that most people don't even associate with income, although they probably should. Today we're putting Microsoft, ticker symbol MSFT, under the spotlight. Now here's how this works. Because you're not here for the hype, you're here to make clear, grounded decisions about your money. So each week together, we're going to break it down simply. We're going to be looking at each company and answering the questions: is the dividend safe? Is it growing? And is now a smart time to be even paying attention? And by the end of this, you'll have a much clearer picture of where this fits and if it fits into your portfolio. Before you think about income, let's take a quick step back, because your dividend is only as strong as the business behind it, right? So here is the real question. How predictable is the cash that's coming in? How reliable is the dividend payment? Or how stable is the company that you're investing in? Microsoft today is not just a tech company, it's a whole system. They've got their Azure platform servicing huge businesses around the world. They have their subscriptions through Microsoft 365. They have AI integrated into everything, and they even own companies like LinkedIn and Xbox and other enterprise tools. And so here's why this matters for you. It's because this creates a solid company with reoccurring income. And when a company has predictable cash flow, it gives you something powerful. It gives you clarity. You're not guessing about whether or not the business can support your income. It's built into the model. All right, let's take a quick pause here, because this is where a lot of people get worried. Microsoft's dividend yield is actually just under 1%. And so if you're focusing just on that number, it's easy to dismiss it, right? If you're thinking inflation is closer to 2.5%, 3%, then what is a 1% dividend yield? But ask yourself this question instead. Are you trying to maximize income today, or are you trying to build income that grows over time? Because those are two completely different strategies. Now, here's the part that should get your attention. Microsoft is only paying out around 20% of its earnings as dividends. It has a 20% payout ratio. That means the remainder, roughly 80%, is being reinvested back into the business for growth. What does this mean? It means that the dividend is well covered, and there's enough cash flow and room to grow the dividend, and there's a buffer if the market gets messy. And so you're not relying on a stretched business or a cash-strapped business to try and keep up payments. You're positioned alongside a company that has options. And now this is where perspective starts to shift, right? Microsoft has also increased its dividends for over 20 years. More importantly, it has been growing that dividend payment by around 10% each year. Let that land for a second. Over the past 20 years, Microsoft's dividend payments have increased by an average of 10% each year. And so if your income is growing at 10% annually, you're not just keeping up, you're actually moving ahead. And this is where you step into a different role as an investor. You're no longer just reacting to the market, you're allowing time and consistency to do the heavy lifting. And that is how compounding starts working for you instead of feeling like something abstract. All right, let's bring it into the charts, because this is where emotion can actually creep in, right? Microsoft has had a huge pullback recently from its highs at about 550 only in July last year to recent lows of about 360. Right now it's sitting at around 370. Depending on how you look at this chart, you can see two completely different stories. Some people could see risk, others see repositioning. And if we zoom out and look a little bit further back, Microsoft is hovering around a key support level. So you're looking at a high quality business now trading significantly below recent highs that is now trading at a key support level. And so we're not trying to time the bottom of the market here. What we're trying to find are good times to make good investment decisions. So ask yourself, could I buy some Microsoft shares today at 373? And if it drops down to, let's say this point, 345, could I buy some more Microsoft shares at that point? Knowing that you're investing in a strong, profitable business. And so when we put it all together, here's what we're looking at. A business with a modest starting yield, but very strong safety margin, and a consistent track record of growing its dividend payments, of growing your income. This is not about chasing quick wins, it's about building something that lasts and strengthens over time. And right now, the question is the market giving us a chance to look at it from a different perspective than it was a few months ago? Because we know we definitely don't want to be purchasing anything at the very highs. So here's the only question that really matters. Does this align with the kind of investor that you're choosing to be? Not reacting, not chasing, but building intentionally. And as I said before, this is not financial advice. This is just about giving you the clarity to decide what makes sense to you. And I genuinely like to hear your take. Are you seeing this as an opportunity, or are you staying on the sidelines for now? Drop it in the comments and let me know. And if this helped you think differently about how you approach investing, hit the like button, subscribe, and stay close. We're just getting started into these deep dives. I'll see you in the next one.